Okay, so Carvana's Q3 just hit. We saw record sales, soaring profits.
Yeah, but the market reaction initially, a little hesitant, kind of focused on this small margin squeeze.
Right. It's that classic thing with high growth stocks.
Exactly. When expectations are sky high, even amazing results can, make people nervous if one little metric is slightly off.
So today we're doing a deep dive into it, not just the headline numbers, which are impressive.
Definitely impressive, but also the strategy behind it, right?
Yeah.
The delivery speed stuff, the AI, the huge new loan capacity. Management thinks that's what sets them apart long term.
Okay, let's break down Q3 then, starting with, well, just the sheer scale.
Yeah, the unit numbers are pretty staggering.
They sold, what was it, a record 155,941 retail units.
Yep, 155,941. That's up 44% year over year.
And you've got to compare that to the rest of the industry.
Oh, absolutely. You look at the average public dealer in Q3, basically zero growth, flat,
So Carvana's not just growing, they're grabbing massive chunks of market share.
at a speed nobody else seems able to match right now.
And that growth, obviously, flows right to the top line. Record revenue, too.
Yep, record $5.647 billion. That's up 55% from last year.
Wow. And CEO made a point about the annual run rate crossing $20 billion.
Yeah, that's a huge psychological and scale number, 20 billion.
And this scale is actually hitting the bottom line now, too, under GAAP,
Right, that's key. GAAP net income was $263 million.
which is more than double last year's Q3.
Exactly. And it gives them a net income margin of 4.7%. They were quick to point out that's like more than double the industry average.
And operating income.
Also a record. GAAP operating income hit $552 million. Margin there ticked up to 9.8%.
Okay, so record growth, record revenue, record GAAP profits. So why the market hesitation? This brings us to Adjusted EBITDA, doesn't it?
That's the one. That's the metric that caused a bit of a stir.
Now, the number itself was also a record, right?
Oh, yeah. Adjusted EBITDA hit $637 million. I mean, that's a huge leap from last year, up $208 million.
But the margin, that's the issue.
Precisely. The adjusted EBITDA margin actually dipped slightly. It went from 11.7% in Q3 last year down to 11.3% this quarter.
Just 0.4%?
Yeah, but when you're operating at this level and the stock's priced like it is, even a small dip like that gets put under the microscope. People worry, is this pressure? Is something changing?
But management doesn't seem worried. Their guidance looks pretty confident.
Extremely confident, I'd say. For Q4, they're guiding for retail units above 150,000, so maintaining that high volume.
Into the full year?
Full year 2025 adjusted EBITDA. They now expect it to be at or above the high end of their old range. That was $2.2 billion.
Assuming things stay stable, of course.
Right, the usual caveat. But still, it signals they think this margin thing is just, noise, not a trend.
Well, they can probably afford to be confident given their balance sheet now.
That's a really important piece. They've got over $2.1 billion in cash sitting there.
And they've really tackled the debt, haven't they?
They have. They paid down $1.2 billion in corporate debt over 2024 and 2025.
So their leverage ratio.
Net debt to trailing 12-month adjusted EBITDA is down to 1.5x. They actually called it their strongest financial position ever.
Wow. Okay. That financial strength, that stability, it lets them make strategic moves without worrying about every tiny quarterly wiggle.
Absolutely. And it connects directly to maybe the biggest long-term news in the report, the new loan capacity agreements.
Right. This seemed like a massive deal.
It's huge external validation. It basically says major financial players trust their underwriting and their platform. They locked up agreements for up to $14 billion in future loan principal sales.
$14 billion.
Through when?
Through late 2027. It's a big commitment.
What's the breakdown there?
They upsized their deal with Ally to $6 billion, and then they added 2 new partners, each committing to $4 billion.
So 3 major partners betting on their finance platform.
Exactly. It's not just about having the cash flow. It secures their ability to fund future growth, potentially at good rates. It really solidifies that their integrated finance arm is a major asset and, frankly, a barrier to entry. Okay, so strong financials, secured funding. Let's shift to how they're getting these results. The efficiency side, SG&A leverage.
Yeah, getting more efficient as they get bigger. That's the whole promise of the model, right?
And it seems to be working. That 44% jump in units let them cut costs per unit.
Significantly. Non-Shape's SG&A expense dropped by $319 per retail unit sold.
$319 per car. That's substantial. Where did those savings mostly come from?
It was sort of 2 areas. Carvana operations, SG&A, think logistics and inspection centers, That fell by $96 per unit.
which is good.
Okay, but the bigger piece.
The bigger piece was overhead SG&A. That dropped by $314 per unit.
So the fixed costs, corporate staff, tech infrastructure.
Exactly. That's where the scale really pays off. Their tech and centralized systems can handle more volume without needing a proportional increase in those fixed overheads. It's proof the vertical integration is scaling efficiently.
But interestingly, they didn't just let all those savings fall to the bottom line, which ties back to that slight margin dip.
Right. They made a conscious choice to reinvest a chunk of it into advertising.
Yep. Ad expense actually went up by $139 per retail unit sold.
So while some might focus on the slight margin compression,
Management sees it as playing offense. They've
Hmm.
got this efficiency engine. They've got the financial strength. So they're hitting the gas on advertising to build the brand, build awareness, build trust.
while they have the momentum, and they expect that to continue.
Yeah, they said expect Q4 advertising spend to be similar to Q3, maybe even a little higher. They're leaning into it.
Okay, that makes sense. It's a strategic trade-off. What about the other profit component, gross profit per unit, GPU?
Right, GPU. Well, as kind of expected, higher depreciation rates were a bit of a headwind there.
So retail and wholesale GPU were down slightly.
Yeah. Non-GAAP retail GPU fell by $77 and wholesale by $168 per unit, mainly due to those higher depreciation costs hitting used car values.
But the other GPU offset that somewhat.
It did. The other GPU that's mainly financing and ancillary products like service contracts that increased by $63 per unit, non-GAAP.
And why was that up?
Two main drivers they called out. One, improved cost of funds, which probably relates back to that financial stability and those big loan agreements we talked about.
Okay.
And two, just higher attach rates. More customers are taking their financing and their vehicle service contracts. So the whole ecosystem is working better together to drive profitability.
All right, let's pivot from the pure financials to the customer experience. Management keeps highlighting this as their core difference, speed especially.
Yeah, the Phoenix test market results are, frankly, pretty wild.
What do they report there?
In Phoenix, 40% of customers are now getting same-day or next-day delivery. 40%.
Compared to what nationally for them?
Nationally, it's around 10%. So Phoenix is operating at 4 times the speed.
And that's possible because of the inventory they have ready to go in Phoenix.
Exactly. The CEO said customers there can browse about 2,500 cars available for same-day delivery. You pick one, click, and it can be there in hours.
That kind of speed, that kind of fulfillment relies heavily on automation, right?
Totally. It only works because their whole system is so integrated and automated,
Yeah.
which leads to incredible self-service.
How much self-service?
Over 30% of people buying a car go through the entire process online, never talking to an advocate until the car shows up or they pick it up.
30%. Wow.
And if you're just selling your car to Carvana, that number jumps to over 60% fully self-service.
That level of automation brings us to the tech advantage, particularly AI. They talked about some pretty advanced internal tools.
Yeah, they use the term ambient agents. It sounds almost like science fiction.
What did these agents do?
So management described AI systems working in the background that can apparently detect operational bugs or issues,
Okay.
diagnose the problem, figure out the solution, actually write the code to fix it, and then deploy that fix.
Without a human stepping in.
That's what they implied. All without direct human initiation.
That's more than just automating customer interactions. That's automating the improvement of the platform itself.
Exactly. It's a self-correcting, self-improving system. Think about that kind of capability scaled across a business doing $20 billion a year. It creates this massive, accelerating competitive advantage.
Because every fix, every optimization happens faster and potentially without adding headcount.
Right. If your system can improve itself, your efficiency curve just gets steeper and steeper compared to traditional guys who need teams of people for every little process tweak or bug hunt.
And that tech moat, that efficiency engine, is probably why they're sticking to that really ambitious long-term vision.
It has to be. Their North Star hasn't changed. Sell 3 million cars a year
3 million.
at a 13.5% adjusted EBITDA margin within the next 5 to 10 years. It's incredibly bold.
But the CEO's argument is that hitting high growth, like over 40%, while having profitability that's double the industry average.
Yeah, he said it points to something that is structurally different. They really believe they've built a fundamentally better mousetrap, not just an online dealership.
And the market opportunity is still vast, right?
Oh, absolutely. They keep reminding everyone they still only have maybe 1.5% of the U.S. used car market.
So 98.5% is still done the old way.
Exactly. Plenty of runway left, which justifies, in their minds, All this investment in growth and tech and speed.
Okay, so wrapping this up. Carvana's Q3, stellar results overall. They really leveraged that volume growth for huge cost savings.
Yeah, and use that efficiency and their stronger balance sheet backed by that massive $14 billion in loan capacity to strategically reinvest in advertising.
So that slight dip in the adjusted margin seems less like a weakness and more like a calculated decision to press their advantage.
I think that's how they see it. The focus isn't on optimizing every single quarterly margin point. It's on building this deeply integrated, tech-driven platform.
Defined by that insane delivery speed, the self-service, the AI.
Right. Something so efficient and complex that it becomes almost impossible for traditional competitors to replicate quickly.
Which leaves a really interesting question for you, the listener, to think about. We see these Phoenix results, cars bought in minutes, delivered in hours.
Yeah, the question is, what would it actually take for an existing competitor, one of the fragmented traditional dealers, to build or buy the kind of integrated logistics, the tech stack, the underwriting needed to even try and match that?
Can they realistically catch up? And is that 98.5% the market that's still operating the old way truly ready for this kind of instant gratification future that Carvana is trying to build?